Hello everyone, it's Derek Pass here. We'll be starting the webinar in about 2 or 3 minutes. Hello everyone, my name's Derek Pass. I'm the BDM for Premium China Funds looking after the northern region. Thanks for joining us today. It's in the midst of these extremely volatile times. As we saw last night, it was the biggest fall in the Dow since 1987, and I'm sure a few of you can remember the 87 crash, the GFC, the dot-com bust as well. It's quite a similar feeling, although in this case we're looking at more of a exogenous event driving the market. I think one thing that will be in common with all these falls is that we will look back in time and see it as also as being an opportunity. Now where we are at the moment, the falls are off the back of the COVID or the coronavirus impact, and today Jonathan Wu, our Chief Investment Specialist, will be talking about the impact of COVID on the Asian region and also on our funds. If you have any questions, you'll see on your screen on the right-hand side there's a box you can click to put in your questions, so feel free to put them in and we'll get to as many as we can. And so with that, I'll hand over to Chief Investment Specialist, Jonathan Wu.
Thanks, Derek. So good afternoon, everybody. As Derek mentioned, we're seeing these sort of unprecedented moves, and ultimately the situation that we're faced with at the moment is very liquid. On your panels, you would see that there is a question box. Please feel free over the course of the next 45 minutes or so. Please put in the questions that you may have, and we'll get to as many as possible. If we can't, we'll loop back around to you because we will know who asked which question. So jumping straight into things, at the moment, one for us, we have to make sure that we have to stick to what we do. Right now, we're in an environment where price discovery has effectively been thrown out, baby with bathwater style, and everyone's just going to cash. So even the, your traditional safe havens of gold and even bonds overnight, you've seen everyone basically saying, I just want to hold on to cash. And even taking aside, what's happening from an economic standpoint, many of you may have seen the news article come out last night about Italy making an announcement that they will need to assess who they effectively will need to treat and who they will admit into intensive care wards, given the fact that their health system is effectively crumbling. Why I'm saying this is not, to put fuel on fire in terms of what's happening in Italy. It is a very, very sort of dark situation. But when you compare that against what we've been faced with in Asia, there has been a very, very different marketed approach to how to deal with containment. So for us, we are still continuing doing our company visits. Our teams are currently grounded as well from the perspective of our teams in China and in Hong Kong, but we're still doing our on the ground, our daily research tasks, and that hasn't changed. Just to reflect on the size of our investment team, remember we've got about 70 people on the ground that are running this day to day. And we are going to keep running these webinars as certain economic events are unfolding. So we just want to make sure we're keeping everyone informed as best as we can. With regards to our Asia fund, just to reiterate that we did do a fee drop from the 1st of July last year, which effectively dropped the fee from 1.78% with a performance fee to now 1.33% without a performance fee. And that now brings us in line with actually below the mean management fee for across the universe of Asia funds. And then at the same time, we got an upgraded research rating from Zenith to recommended. And you would see this is our performance chart track record that we've updated right now to the 29th of February. And what you'll see is that we're running at around a 210 basis point excess return above the index since inception, where we just turned 10 years old. So we are a quartile 1 fund for 5, 7, 10 years. Over the 3 and 1 year period, I will talk about that in a minute, because that will reflect on what we're doing with the portfolio, something that we're clearly not concerned about. And I'll walk through sort of those themes in a minute. What is also key to remember is that the performance that we've achieved for clients over the long term is not only the fact that we've outperformed the benchmark as well as our peers, but in terms of Sharpe ratio, you can see on every time period, again, these numbers are updated till February. End of February, we have outperformed on our Sharpe ratio against the peer median since inception and across all time periods. So let's jump right into what's happening now with COVID. We do recognize this is a serious event. We are definitely not here to say that it is not. We do still hold on to the fundamental view that this is an event rather than a long-term trend. This ultimate ideal that we hold, people can agree or disagree, but from our perspective, it does not divert what we're doing on a day-to-day basis, but it does provide us with opportunities to consider how we're positioning the portfolio, both from an event perspective as well as a trend perspective. Given the level of extreme containment, we believe that there are sort of shorter-term impacts across Asia. More specifically, I'm talking places like China, Hong Kong, Taiwan, Singapore, which do have effectively a mix between the strong enough monetary and fiscal stimulus capability, which I'll talk about in a minute. I noticed someone did ask a question around the stimulus package that's coming out in China. So I'll walk through that, as well as the fact of just the culture. Okay, and the culture, I think we cannot put to one side, because if you consider one of the things that Western or developed economies have that Asian countries do not, is that they don't have the same level of social infrastructure in regards to hygiene and things like that. So if any of you have actually traveled to Asia sort of in the last 10 years, you would have seen that if someone is sick, they are wearing a mask. That is not something that we are akin to here in the Western world. And I was in New Zealand last week, and I also didn't see a single person wearing a mask. And taking that into account, this is why the Chinese government has been so strict in the way that they've been handling this crisis. And I'm going to show you sort of what they've been doing around that. We are not trying to do a direct comparison here against what happened in SARS, because from a health positioning perspective, it is different. So if you look at from the medical viewpoint, SARS in itself was less transmissions from human to human, but the death rate was higher. In this time around, and I think that's sort of one of the factors why the WHO have called this a pandemic, is the fact that things are now transmitting faster, but the death rate is far lower. And what you can see here on the right-hand side is that you can see that the performance of the Hang Seng and the S&P also did markedly bounce by the end of the year. It feels at the moment to everybody in the retail space that each day seems to just be getting longer and longer. And it seems like, what happened last week seems to be a distant memory given literally what's just happened in the last 24 hours. But the fact of the matter is that, there is no price discovery at the moment. We recognize that. It does not mean that people just go to cash, right? That is not the rational behavior that we would expect. But right now, the market is simply irrational in nature. If we do look at what has happened post-SARS from a GDP bounce impact as well as tourist arrivals bounce impact, they bounce back quite quickly. We can drag this out for a couple of quarters. That's also expected. But this is going to pass, and price discovery ultimately back into the equity market will occur. If we look at what's happened this time, and these charts are literally being updated day by day. So the left-hand side chart's actually updated till the 10th. And what you've seen in confirmed cases, it's now basically dropped off to almost immaterial numbers. Last night, from memory, I think it was around 14 cases, of which 3 of them were actually imported. So we're now seeing this sort of even a circular event starting to happen. There has been some pundits in the market saying, okay, if this situation is now circular, what does that mean? Because China, the epicenter started in China, then it got exported, and now it's re-importing the virus. So from that perspective, as long as China continues to keep up its containment efforts, which they have been successful in doing so, you will continue to see cases come off. What is reflected on the right-hand side, though, is that Bloomberg does run a news count. So the news count effectively is looking at all global news agencies and finding keywords around coronavirus, and they are just tracking that each day, which is the reference point on the left-hand side. So we're talking like 11,000 news articles per day and continuing to climb. What you will note is that that is highly correlated against the performance of markets solely because that is a sentiment-driven situation. We've put in the S&P 500 as well as the HSI or the Hang Seng Index in this case. So this is one of the things that we're sort of monitoring day by day to see at which point does price discovery come back. And one of those sort of metrics is that if the Bloomberg news count starts to fall off, which is a reflection of people are less concerned about it, then you'll start to see price recovery come back. From a stimulus perspective, you'll see on the screen that PBOC has already cut 10 basis points to its medium-term lending facility. And they've also injected 1.2 trillion yuan. So fundamentally, what we need to consider in this environment is that, and sort of something similar to what Scott Morrison was talking about when he announced the stimulus package here locally yesterday, is that the focus is on solvency. Okay, and what do you need to ensure solvency? You need liquidity in the system. So this liquidity that they've injected, what they have made very clear to the banking system is that you are there now to provide a lifeboat to factories to keep them open. Okay, regardless of the amount of activity. And remember, this is now over a month ago. Okay, and what has now happened since then? I'm going to show you these figures. Is that, and one sort of line I didn't update from my last presentation is that about 3 weeks ago, we were seeing production levels at about 20–30% capacity, right? But those figures are far higher now, and that's measured on the ground in China at the moment. I'll share that in a minute. But effectively, if this stimulus keeps going on for the next couple of quarters, China does have the ammunition to do it. and it has the ammunition solely because its interest rates or its prime lending rates are far higher than the Western world. And most of these charts are moving day by day. This chart is looking at our concerns now across the rest of the world, because effectively, while China's new cases have fallen off, and this is only up until the 1st of March, it just gives you a sort of an idea about how this is going to play out. You've seen the US, and the US have sort of taken a number of strategies to try to, I guess, divert the attention. One thing is the Secretary of State has unfortunately, in our opinion, has gone out and just said this is not coronavirus, this is the Wuhan virus. So it's sort of more of a political sort of jockeying just to try to, deflect what's happening on the ground. We've seen cases where even nurses in California can't get tested because it's just a whole bunch of red tape at the moment. And when you compare that against what's happening in China and Korea, it is a stark difference. What Italy has done, unfortunately, is sort of too little too late. And this is going to spread faster. And if you consider sort of the stimulus package that the Italians have come out with, and then you compare that against what's happening in Asian countries, it's also markedly different, because the Italian finance minister came out yesterday or the day before and announced that mortgage payments are going to be frozen. Okay, then you've got people now commentating on that and saying, how does that deal with the solvency of the banks? Because the problem is if you stop paying mortgages, then banks have no ability to run their own businesses. Then further to that, a lot of the Italian bank bonds are held by Italian households. The circa levels that we're seeing is around 200 billion euros. So if they don't have income, how do they pay bondholders? It becomes this circular argument. So some stimulus packages will work, some of them won't. We think the ones that are happening in Asia are focused solely on ensuring the solvency and liquidity of businesses. We believe that as an example, as I said, Italy, we think that it's not as poignant and it's not as targeted. We had this chart up at the end of February, and since then rates have been sliced and diced across the world. So you have seen US done 50 basis point emergency cut. You saw the UK do 50 basis point as part of their strategy. We've done a 25 basis point cut. Korea is currently evaluating whether or not they should cut further, and the China medium and longer term facilities, the long-term prime rate, are sitting at far higher levels. This is something we have to be cognizant of. It's all around ammunition. One of the global views we have at the moment, which relates to equities, is that where we are sitting in at the moment is not 2008 from a monetary standpoint. One of the key reasons, as we all understand now, as to why equity markets have remained frothy, and most fund managers are talking about why higher justified valuations are here to stay, is related to the cash rate, which reflects to cost of capital and your ultimate discount rate. So you have to consider that in this context, what's happening is that even though equities have taken a massive dive, no one is expecting rates to go up. Okay, and not in a meaningful way. Whereas prior to the GFC, rates were a lot higher than where we are now, and therefore cutting it provided that stimulus and provided that sort of more of a blunt instrument to restart the economy. Whereas now cutting rates in of itself does not work. But from an equity investor standpoint, if you have 16 trillion of negative yielding bonds, and cash is not an option because rates are so low there, then most retail investors and most managers will divert their money back to equities, and that's something to be mindful of. So it's not only in our position, but equity managers globally. This is sort of an opportunity to bottom feed. When we then look at the daily production level at the moment, someone just asked a question around slides. Everyone that's attending now will receive a follow-up email after this, and then the slides will be attached there, so please feel free to use them with your clients. This is the production activity tracker that we're seeing here, and that sort of bottom point is Lunar New Year. And we've then correlated, this is the data from the CICC research in mainland China, and we're correlating this and looking this over 2018, 19, and 20. So LNY represents Lunar New Year or Chinese New Year, and the number of days after that. So using prior to Lunar New Year as the base, so 13 days prior, and then indexing it now all the way till now, capacity is now reached about 76%. And this is what we need to focus on, because, you know, there is, as I said before, liquidity is great until you become insolvent. And one of the things that the central Chinese government is very cognizant of is the fact that they have spent so much effort since 2017 to slowly deleverage the economy. So as they've deleveraged the economy, they've removed a lot of the credit excesses. Now that is a combined, you know, government, central government and local government initiative, and the central government has taken over some of those local debt burdens away from the locals to remove pressure from them as well. And so as they're putting the stimulus through the system, it does create new credit issues, right? Now, this is not a China-centric, this is a global thing as well. Most economies are just printing money to get themselves out of this crisis. But as the capacity utilization is continuously increasing, the solvency risk is decreasing, okay? Then if we look at a freight logistics activity level, we're also back to around 81%. At this point in time. So the question that we then ask is, okay, is this time to go into equities? Now, we're not going to position ourselves now and say this is the bottom market. We genuinely have no idea. And it goes back to this point where there is no price discovery. As long as there is no price discovery and irrational behavior reigns king in the market, no one knows what's going to happen, okay? But what we want to show you is, are you being paid? Or more cognizant is, where are you being paid to take on risk now? Okay. So at the end of the day, we have to look at what is the equity risk premium. Okay. The equity risk premium is effectively the earnings yield of the country less the risk-free rate less inflation. Okay, and we know inflation doesn't really exist in any meaningful way at the moment globally, so that's sort of not a big issue. Risk-free rates, record lows. And you've got earnings yield, which is not necessarily as strong as they were prior to the GFC. But given the fact that both of the second two minuses, being risk-free rate and inflation, is low, we then need to look at this point in the cycle, where are you being paid to take on risk? These figures are ending the end of February. And what you see here is that Asia is giving you an equity risk premium of about 4.8%. If we wind back 30 days before that, the equity risk premium ran at about 4.3%, with Asia ex-Japan being higher. And EM is catching up. Obviously, EM is made up of a number of countries which right now are battling the COVID-19 situation in probably less than ideal conditions from a health standard perspective. But globally, if you compare global against Asia, you are being paid to take on the risk if you are invested in the market at the moment. If we then look at these valuations are sort of getting close to the end of February, doesn't take into account the sort of turmoil we've seen in March. But what you do see is that Korea presents as the most attractive place to invest. It is sitting outside sort of standard, or it's sort of the outlier at the moment from an EPS growth perspective, solely because they're coming off a low base. It's not actually particularly exciting, but they are coming off a low base, and they are still one of the cheapest equity markets in the world. Okay. As of last night, just so that everyone may have seen, Morgan Stanley, over the course of the last 24 hours, have announced their own reweightings to the equities market, and they are now calling for overweight in China and Singapore as their key countries, because these are the places where the virus seems to be passing from a material impact on the economy, and things are sort of starting to return back to normal. And they're underweighting effectively most other equity markets in this environment. Then following on from that, and why we've got a sort of a second chart here on Korea, is that Korea over history, and we're talking sort of 15 years here, is that more so and more so, Korea is being discounted, okay? Korea is being discounted. And what's happening here is that from our perspective, we have a sort of sub 20% allocation to Korea, which is sort of higher than benchmark indices. And why we're there is because we're invested in that trend. Okay, most fund managers, for example, own Samsung Electronics for different reasons. We sort of buy and sell into Samsung based on the DRAM cycle, and that's a long-term thing. But at the same time, Korea's equity market has been going through an exceptionally volatile period, even prior to coronavirus, and you can see that discount has been steadily increasing. And especially with coronavirus starting in the city of Daegu, that has also exponentially increased the risk in that market. But if you look at what they've done in their containment, they haven't gone and contained the entire country like Italy has. What they've done is that they've taken a 3-tier approach, which is trace, test, and treat. And right now they're testing 20,000 people a day, and you're getting results in 6 hours. Okay, so you're seeing some pretty rapid ability for these sort of test centers are popping up everywhere across the world. Across Korea, which is being very, very effective. To give you an idea of where our fund is positioned at the moment, these are figures ending February. Most of these companies have suffered. Okay, and I'm not taking anything away from that, because I'm going to sort of walk through 2 specific case studies in a minute around stocks that have been significantly impacted by an event, but it doesn't change the long-term trend. Okay, and again, this goes back to what the time frame of your investors are at the end of the day. So things like Alibaba and Tencent being our top and our 3rd largest holding. Those structural trends around e-commerce, those structural trends around food delivery, like the Uber Eats of China, those are not changing. Okay, you've got things like TSMC in our portfolio, as well as MediaTek. Both of those are integrated circuit manufacturers. MediaTek is the 4th largest designer, and their stocks have been absolutely ravaged in this current period. We're also holding Chow Tai Fook as our 10th largest holding, and Chow Tai Fook is the Michael Hill of Hong Kong and China, where most of their presence is inside China. We have been increasing our holdings in stocks like these, because if you consider where Hong Kong is in this environment, it's sort of had the double whammy. Okay, it's had the unrest it's gone through last year. It also copped a bit of sentiment throughout the US-China trade war Mark I, and then they sort of doubled down over coronavirus. Okay, if you also look at Hong Kong's containment, successful containment of coronavirus, it's also been highly successful. So where the PE stands for the portfolio at the moment is that it's sub 12. And our dividend yield is 3.8. Now, taking aside the event, if you consider where the dividend yield is now compared to where the dividend yield of the portfolio was, say, 6 or 7 years ago, they were sort of mid to high 2s. Okay, so one of the things that has been sort of happening within Asia is that companies are starting to mature up. And one of the results of things that are maturing up is that companies are having higher payout ratios. Okay, that's just the natural evolution of the market. Okay, so someone's just asked when the recovery starts, where the best growth will be. Is that these are these long-term structural trends that we're invested in day in and day out. Okay, if you look at sort of the calendar year for us ending December last year, where we actually made the most returns for your investors is all around consumption. Okay, Anta Sports is sort of like a 2nd tier sports apparel brand inside China. You've got Alibaba Group, which everyone sort of understands. Samsung Electronics, which I've talked about in terms of we're buying into the DRAM cycle. So RAM chips for phones and computers, tablets, so on and so forth. Nissan Foods, which is instant noodles, which I'll talk about in a minute, and Live and Precision, which actually produces the camera modules for iPhones. Okay, these are all consumer-based stocks where we are making the most money. In terms of our rolling return profile, this is what we're looking at. 3-year rolling returns. These are all ending February now. It sits somewhere between 20% and 100%. So 3 years is never a good measure for investing in strategies like us, solely because of the fact that the underlying market is more volatile. You've got 5-year rolling returns. So the minimum return you would have made on any rolling 5-year for us is somewhere between 60 and 130%. And over the 7-year rolling period, the minimum you would have made is almost double your money, all the way to about 180%. Okay, so this is all really important to remember, that contextually we need to remember why you're invested in Asia, and are you invested in an event or are you invested in a trend? Okay, because it's a very, very different. If you look at where our sector exposure lies at the moment on the left-hand side, information and consumer technology, that's 60% of our portfolio. Okay, almost 60%, and you know that is where the new economy stocks all lie. Okay, and with all those new economy stocks, that is what we're focused on, because all that is related to trends. Okay, everything is related to trends. At the moment, in terms of our geographical exposure, directly China, we have Hong Kong at 35, we have China A shares at 6, which I want to come back to in a minute. And then we've got H shares at 5 and red chips at 2. Red chips being Chinese companies that are incorporated in sort of tax havens but are listed in Hong Kong. So it's 35 plus 11 plus 2. Okay, we're holding on 5% cash at the moment, and we're deploying it day by day. We don't hold 5% cash now as at yesterday. So it is well diversified. And just to explain why we're holding that Korean exposure at 15%, I hope those couple of slides beforehand explained where we're sitting with that. I want to give you 2 sort of stock stories and case studies for you to take back to your clients. One is Nissan Foods. Before I start on this, there's a question that came in and asking, will you add financials to the portfolio? Not necessarily. There are structural headwinds for banks going forward. Last couple of years, China's gone through a sort of interest rate deregulation scheme where it has led to banks having to compete for money. So compared to Western markets, we're not necessarily of the opinion that structurally Chinese banks is the best way to be invested in. Yes, they do pay a good, decent yield of around 5.5%, but and it's higher now given what's happened, but in saying that, structurally we think we can find better growth elsewhere. Going back to Nissan Foods here, they are an instant noodle manufacturer. They started in Japan and they decided to spin off their Hong Kong China business into a separate listed company in Hong Kong. And you see the company is, you know, it's a very substantial company. You know, literally 3 weeks ago it was hitting $1 billion US. But what you see here is that this company only targets high value instant noodles. Now, why is this important? Because across the whole of China, the instant noodle market grows at 1% per annum. Now, we have to change, sort of contextualize this stock, because think of instant noodles in Asia like bread in Australia. Okay, you can buy cheap bread, you can buy expensive bread. What actually then directs why you're going to pay more money for the same good, it is just simply carbohydrate, is because you earn more. Okay, so you know, when you first started work after being a poor uni student, you buy a loaf of Coles bread. Okay, but then as you work and you work your way up, you start having a family, you'll buy bread that costs 4 times as much, and the reason is because you can afford it and it's of a high quality. The whole Asian structural story is on the back of this. Okay, and this is simply one example of many that we're invested in that follows this trend. We call it premiumization. Okay, the high quality instant noodle market in China that is selling at 5 RMB or effectively $1 or more per cake is currently growing at a rate of 12% per annum. This is all Nissan Food does. Structurally speaking, they have a number of competitors which are trading closer to 30 times. For Nissan Foods, they trade at a discount to that. So us as a relative value manager, we find that to be very attractive. So this is the premiumization. The other big trend is sitting in our top 10 holdings at the moment, which is MediaTek. Okay, Taiwan listed, integrated circuit manufacturer, 4th largest after Broadcom, Qualcomm, and Nvidia. And they have a 40% market share in emerging market smartphones. Okay, of which a lot of that is in China as well as in India. Very diversified client base. They've dropped 27% from the peak. Now, what is interesting to note is that across Asia this time, the rate at which the market has corrected in Asia has been somewhat markedly less than a lot of Western markets, which has been very interesting to see, because this is probably the first time where we've engaged a crisis, where we've seen the markets in Hong Kong, even for example today, after last night, the Dow dropping at its record level, just under sub 10%. China's Shanghai at the moment has dropped around 200 odd basis points today, and Hong Kong is around 400 odd basis points today. And so, 27% from the peak for us is a reasonable correction, and we're not overly concerned. I mean, you've seen sort of Western company stocks, cruise lines drop 80% in 3 weeks. And these are companies that are much bigger than MediaTek or Nissan. But why we're continually invested in this company, and we're top up on stocks like this at the moment, is because the structural trend hasn't changed. Right? There is still a war happening across the world around 5G deployment. There is no slowdown on a long-term basis as to whether or not 5G will continue, because coronavirus and a trade war combined does not derail 5G, right? So all these markets we're seeing on the left-hand side of that chart, from cloud data infrastructure to smartphones to 5G chips, it does not change. Share prices have corrected, we accept that, right? And we rotate out of stocks where they have been more expensive, and recently sort of been some of those A shares at the moment that we've been slowly rotating out of, which I'll come back to, and rotating into these sort of more attractive stories for us. The last thing I want to touch on, and this is the longer term trend that everyone needs to understand, and I've just written an article about this that's being published in Money Management, because I write 2 opinion pieces for them as a China specialist, and I'm talking about this issue now. When we launched our business back in 2004, you had an active choice whether or not you wanted to be invested in China or you didn't want to be invested in China. Today, where we sit, after what has transpired over 2019, you don't really have a choice as to whether or not you want to be invested in China. You effectively will be, either by proxy or by default through passive flows. But there's a massive problem that we need to address. Because last year, MSCI, after a couple of years with the Hong Kong, Shanghai, and Hong Kong, Shenzhen Stock Connect programs, those launched A shares for the mass market globally. Okay, so for institutional investors wanting to get into China A shares, they had these 2 new tunnels to be able to access China A shares. And MSCI said, okay, now we start flicking the on switch. So as part of the indices for emerging markets, as well as the global all-country index, China A shares is starting to be added in, of which by the end of last year, they already had a 20% inclusion point, which weighted 3.3% of the world into their indices. Okay? And this is very, very important, because this is fundamentally changing the way people invest. But here's the problem. Everyone's invested in some way, shape, or form inside China. And if you're investing directly into China, our next problem will be something called MiFID II, MiFID II. I encourage all of you to research into this area, because it fundamentally changes the way fund managers interact with their execution partners and how they actually derive their research. Okay, because MiFID II started at the beginning of 2018, and it hasn't really impacted where we're invested in until now. Because everybody, through the Hong Kong, Shanghai, and Hong Kong Stock Connect programs, have been funneling money into China indiscriminately into passive flows. And where we've seen, and which has given us a great opportunity in the last 2 months, is to unwind some of those A-share positions, which are effectively ultra large cap stocks. And these ultra large cap stocks are overvalued, and we already started reducing our holding in those in sort of late 2019, and it's allowed us to rotate into cheaper stocks. And here's the problem. Fundamentally, everyone needs to get that default access into China. But with MiFID II, generally, brokers have provided sell-side research to their fund manager clients for free, because you give them a certain level of brokerage. That has changed with the advent of MiFID II, and you need to unbundle research and brokerage. So right now, investors, as in the financial advisors on today's webinar call, your clients directly pay for the cost of transactions, okay? When fund managers, including ourselves, trade. At the same time, those fund managers, including ourselves, have gotten broker research. But going forward, we can't do that anymore, which means that the research cost needs to be separately absorbed by the fund manager, whereas previously they didn't have to pay a cent for it. Now, why is this important? It is important because historically, an investment team could be based in a place like Sydney, investing into global equities, and do their own fundamental research and fill in the gap with execution partner sell-side research. Going forward, if they do that, it's going to be an extra added cost onto their P&L, and we know there has been downside pressure on fees. And the other issue is that if they're not willing to, how do they cover the ground? How do they cover ground in a place like China, where we all know that the level of transparency is lower and you need the on-the-ground research? This is why we go back to the fact that we do 6,500 company visits a year with an investment team that is 70 members in total. So when fund managers come to you in the next 12 to 24 months and start talking to you and saying, we're now in China, be very, very cognizant and ask them, how do you actually derive your research? Because while we have done this in the past, if I was to come to any one of you today and say, hey, I've got a great value Aussie equities manager. Where are they based? Oh, they're based in Hong Kong. Your simple question will be, how do they derive their research if they're not on the ground? I highly recommend you all to do the same thing with your outsourced investment managers going forward as well, because that is a key input into the future of investment management. Then there is this issue around A-shares. A-shares is going to grow in importance in client portfolios and investment manager portfolios over time. You may have seen a number of studies, most of which the ones that I've seen have come from Morningstar, and they talk about developed market equity managers, active managers, not being able, on average, to outperform their benchmark. From our opinion, the reason is simple, because information asymmetry is very low, information is very transparent, and it's very, very easily accessible. In China, it's not. So if you have extra insights because of the relationships that you have developed over time, you will outperform. What you see here is the average of 90 funds, the average of 90 active A-share managers on the ground in China, and their return profile for 10 years. If you just want to look at the longer term, it's 2009 to 2019, and then each year it's sort of slicing a year off, okay? And on average, China A-share managers outperform the benchmark. Why? Because information is not transparent. For us, we don't want to lie. We've been in A-shares since the beginning of our investment in Australia in 2004, 2005, but we haven't had an A-share dedicated strategy. What you see there in that sort of last two boxes with that green line is a reflection of the direct A-share strategy we have that invests all into A-shares. We don't want to mislead the market by saying these sort of 8 stocks we hold in A-shares at the moment and what did that do over a time period. That's just misleading to the market. We don't want to do that. But 90 managers in total, on average, outperform CSI 300. Okay. I have a couple of questions here from the audience around fixed income, so it's good that I did put 2 charts here. So the fixed income fund has held up really well. It's done 100 basis points for the month of February. One of the key things that is the ultimate concern for us in the fixed income space is around solvency. Okay, so we talked about Italian banks not being able to pay the coupons on their bonds. We are fearful of the same thing, and we're a very conservative manager in that sense in fixed income. We are worried about the ability for companies to pay their coupons. So as most of you know, 60% of our portfolio is in Chinese property companies because we want to be conservative. Happy to take questions on that or take this conversation offline. But we have been conservative in our portfolio construction for 9 years, which is the length of this strategy, by being 60% in property companies because they're measurable, highly transparent, and there's a daily market value on property and land. Okay. For the calendar year this year, in the property space, there is $23 billion US of debt that needs to be refinanced. Okay, of which by the end of January, 17 billion had already been locked in. Furthermore, we have seen obviously developers, as a consequence of the coronavirus breaking out, they have obviously effectively slowed down acquisition of land and obviously starting new developments. And at the same time, local governments have used almost 70% of their yearly quota in issuance of new bonds this year, okay, into the market. So therefore, they are shoring up their liquidity for the next 12 months. One of the key things I want everyone to focus on here is that we have run an annualized return of 10% per annum. Okay, and our family is the largest investor in this portfolio at around $4 million, and we've run the volatility at 5%. Our target volatility is actually somewhere between 6 and 7, but because Gordon has managed the currency exceptionally well over 9 years, that volatility has gone down to 5%. So to give you a live example, at the moment, our portfolio is around 90% unhedged. And that is a reflection of the fact that the AUD obviously is a very much a risk-on currency. So when risk is on, then the AUD goes up, and in this environment, it does not. So if there's any mark-to-market risk on the portfolio with the Australian dollar coming off, that has allowed an offset in performance, and we've generated 100 basis points in net performance for the month of February. We have now, across this sort of 9 years, so 9 fours is 36, 35 observable distribution payments for this strategy since 2011, and out of those, it has always paid 150 basis points or higher without fail. One of the key things that we are very concerned about is that there are people out there at the moment saying, oh, bonds are still a safe haven, bonds have outperformed, and it's all around, obviously the risk-free rate and, 10-year USTs, getting to an absolute bargain basement level of 30-odd basis points around 48 or 72 hours ago. One of the key concerns we have is that bond portfolios today, there's a market difference between their cash yield. So if you look at what our cash yield is, it's running at about 8.5%, and our yield to maturity is 10.8%. So here's two things. If your yield to maturity is higher than your cash yield, then on average, our portfolio is trading at less than $100. This is a reflection of our investment strategy of finding bonds in the market that are underloved by investors. And therefore, that is why our yield to maturity is higher. Our time to maturity is about 1.6 years, so it's not long. These are all fixed rate bonds, so they're not impacted by floating rates. And effectively what we're saying is over the next 1.6 years, you'll pick up an 8.5% cash yield with another sort of 2.3% in capital gains on a per annum annualized basis, okay? When those bonds come to maturity and they get close to that $100 value. We have seen many, many bond funds. And a really good example is if you look at benchmark Australian bond funds, the yield to maturity is around 0.7 of 1% with the cash yield at 3. So what you're saying is if you're willing to be invested into these sort of products at the moment, you're effectively saying to your clients is, here's how you lose money investing in bonds. All right. You want to hold tried and true to your client and say, can I provide a bond strategy that has downside protection in the case of, is there a spread between my cash yield and yield to maturity, in which we do, okay? The other great thing about what we've been able to achieve with this fund is that it runs at a correlation to Australian aggregate bonds at about 0.4. For global aggregate bond index, it runs at a correlation of 0.3. We are highly uncorrelated to the rest of our market because there is effectively not much emerging market bond funds out there. There are some that run multi-currency and are willing to take the currency risk. We don't. So all the bonds that we take that we buy for you is only in US dollar form. So that's something to remember there. And then the question comes back to our performance in terms of what's the worst drawdowns we've seen in 9 years, noting the fact and being very cognizant of that we've gone through two emerging market debt crises and one Chinese debt crisis in 2008. Okay, so 3 crises. So it's not like this fund hasn't been through enough cycles as it is. Our worst 12-month performance is 206 basis points down. Our worst 3 months is 265 basis points down. And our worst 3 years is 6.5% per annum. These are all net figures. Our worst 3 years in this fund, including 3 crises, is 6.5% per year. This is all drawn from Morningstar ARC. Okay, So I'm not even going to talk about the best time periods. I'm just focused on worst time periods. At the moment, everyone is worried about negative downside risk. Okay. So that's all the slides that I had. I'm just going back to these questions and seeing if anyone's asked questions on here that I haven't answered. I've answered the question stimulus. Matt, I hope I answered the question for you on high yield debt. Can we possibly do something like China, Australia and stop the spread of the virus? Tony, I can't comment on that. That is a political question. You'll get the copy of the slides. Someone's asked me around, oh, Matt, ERP. Yes, I'm not saying that's the best or the worst way to use a metric. All I'm saying is that that is one measurement that we use. And solely in this, going back to this environment where there is no price discovery, then without price discovery, if you are positioned in a particular place in the market or a particular equity market, you need to consider whether or not you're being paid fairly for the risk that you're taking in a market where there is no price discovery. So yeah, we can pull out a billion metrics. That's just one that we use. Someone's just asked about the slides again. Yes, after this, you'll receive a follow-up email that will contain all the slides, fact sheets, and also research on our product. So that's all there for you. Does anyone have any other further questions they want to pose? Okay, so as this situation becomes more and more liquid, we will plan to have more webinars when we have more information at hand. As I said before, feel free to contact us. Derek looks after the northern region, and I look after the southern region. Please reach out on the numbers that you see on your screen there. In the follow-up email, you'll also have both me and Derek's direct mobile phone numbers and emails to reach out. But other than that, if there's no other questions, I wish everyone a lovely afternoon and a great weekend ahead.